In this week's video, we'll review the latest charts to help us answer the question, are investors missing alarming similarities to major market peaks in 2000 and 2007? In the present-day environment, there's a reason we're constantly asking the question, from a probability perspective, does 2018 look like a normal correction within the context of an ongoing bull market, or does it look like the beginning or early stages of a new bear market? Bear markets can cause devastating losses, a 50% loss after the dot-com bubble burst, a 58% loss in the financial crisis bear market from the highest high to the lowest low, and an eye-popping 89% loss in the 1929 to 1932 bear market. The downtrend in this case lasted 1,039 calendar days. Contrast that with a normal correction within the context of an ongoing bull market that goes on to make a higher high in relatively short order. In the first segment of the video, we will compare the present-day NASDAQ to the major market peak that occurred in the year 2000. In the second half of the video, we will compare the present day to the major market peak that took place in 2007. Thus, the million-dollar question, how similar is 2018 to the major market peak that occurred in the year 2000? If we looked backwards from the major peak in the year 2000, 16.66 years, the market had risen 1,513%. Contrast that with the consolidation period that we just went through. The next 16.66 years featured a gain of 0%. Easier markets are followed by harder markets. The market needs to consolidate its gains. If we look backwards from the peak in the year 2000, prior to this big move here, the NASDAQ formed a 6-year base. Harder markets are followed by easier markets. After 6 years of a harder market, the market rallied out of this base for 9 years. In the present day, we also have a rally out of a base, but there's a big difference. This was a rally out of a 6-year base. This is a rally out of a 20-year base. And the fact that markets move in fractals, we know the expression, the longer a market goes sideways, the bigger the move we can expect to get. That expression applies to a 1-minute chart, a 60-minute chart, all the way out to annual charts if that's what we want to look at. It's fairly obvious that a 20-year base, the longer a market goes sideways, is quite a bit longer than a 6-year base. After a much shorter basing period, the NASDAQ rallied for 9 years. If we rallied in a similar manner out of the much longer 20-year base, instead of rallying for 9 years, it's within the realm of possibility that the market could rally for 30 years after breaking out. There's a retest here that occurred in November of 2016. And as always, this is absolutely, positively not a forecast that the NASDAQ is going to rise for 30 years. The concept that the longer a market goes sideways, the bigger the move that we can expect to get, and the fact that we had a 9-year rally out of a 6-year base tells us that we should keep an open mind about the NASDAQ moving in this direction for much longer than we can comprehend or wrap our minds around at this point. This major peak here occurred 9 years after the basing period. We retested this breakout here in November of 2016. Thus, how many years are we from the base today? We're 1.55 years moving in this direction above this 20-year base. Therefore, if the market rallied for 9 years out of the 20-year base, you could make an argument that we might have 7 years of gains in front of us. And if we move proportionally to a 6-year base followed by a 9-year rally, a 20-year base could be followed by a 30-year rally, and we would only be 1.55 years into that rally hypothetically. This is the big difference between the two periods. If we're trying to make an argument that the present-day NASDAQ is just as risky as the NASDAQ in March of 2000, that's a very difficult argument to make. The further you move away from a base, the higher your risk. Why? We really don't have a lot of support below this market. The market here is moving in an almost vertical manner and is extended from a base. At some point, markets need to consolidate their gains. Let's compare and contrast that to the present day. Here, we're 9 years removed from the base. In the present day, only 1.55 years. Look how far we would have to fall to get back to the base in this case, and contrast that with how far we would have to fall to get back to the base in the present day. This doesn't look anything, not even remotely close to this. And you may have noticed that these charts here are dated February 13th, 2018. Well, the NASDAQ hasn't moved much since February 13th, 2018. The highest point shown on this graph here is 75.05. During the trading day on May 25th, we were only roughly 80 some odd points above that at 75.88. If we look at the NASDAQ from 1978 to the peak in 2000, when we move backwards in this direction, we will never hit price or be anywhere near price in the rearview mirror because the market is so extended and it continually made new all-time highs. That's not the case here at all. We're not even close to making a new all-time high here. The first new all-time high comes in 2016. If I look backwards from this point here, I can hit price 16 years prior. We don't have anything like that up here. This is a much riskier situation relative to the present day in the NASDAQ. And just to show that the charts we've been looking at dated February 13th are basically identical to a chart that we would look at on May 25th, not much has changed here. We are not extended from this base here. The look of this chart is basically the same in the present day. Harder markets are followed by easier markets. Easier markets are followed by harder markets. And these bases are drawn the same way. We basically take the lowest low, move backwards to where we can draw a horizontal line. Price is at the exact same place here as it is here. Price is at the exact same place here as it is here. You'll notice in this case, this low here is higher than the bottom of the base. This low here is higher than the bottom of the base. Harder markets are followed by easier markets. Easier markets are followed by harder markets. Harder markets are followed by easier markets. The longer a market goes sideways, the bigger the move we can expect to get. Once again, telling us to keep an open mind about much better than expected outcomes going forward. It's not a forecast. We'll continue to take it day by day. And obviously, if the NASDAQ falls back into the 20-year base, our assessment of the probabilities would change. But that hasn't happened yet, and it's not even close to happening in late May of 2018. What about the theory that the present day NASDAQ just went through a speculative blow-off top, similar to the speculative blow-off top that occurred in March of 2000? This is the highest closing high here in the NASDAQ. It occurred on March 9th of 2000. If we looked backwards, and this is where the blow-off period begins here, back to November 1st, that's 129 days. So this is the last 129 calendar days of the NASDAQ bubble. Unbelievably, in 129 calendar days, the NASDAQ gained 70%. This is what a speculative peak looks like. If we look back 129 days from the highest closing high in the NASDAQ in the present day, have we gained 70% or anything even remotely close to 70%? The answer is absolutely, positively no. This is the highest closing high that's occurred in the NASDAQ. It happened in March 12th of this year. If we look backwards 129 calendar days, instead of having an eye-popping and unrealistic and unsustainable 70% gain, we have a much more muted 12% gain. This high here doesn't look anything like, not even remotely close to this speculative look at the end of the NASDAQ bubble in March of 2000. It is more likely that this is the important peak here. This was a correction peak. This is the normal correction within the context of an ongoing uptrend, and we've already exceeded this, telling us that it's well within the realm of possibility that the NASDAQ's correction is already over. Obviously, that is to be determined, and we'll take it day by day. It's very, very difficult to say that the highest closing high for the NASDAQ in 2018 looks anything like the highest closing high in March of 2000. In fact, the magnitude of this move is 5.83 times larger than the magnitude of this move. We just illustrated the present day looks quite a bit different than this period here in calendar year 2000. Now let's shift gears to this period here, or the transition in late 2007, early 2008. It's a daily chart of the S&P 500. Left side of your screen, calendar year 2017. Right side of your screen, the present day as of May 23rd, 2018. The S&P 500 peaked on January 26, 2018. These charts were created on Wednesday, May 23rd, which was 117 calendar days after the peak that was made in January. Now let's look at the peak in 2007. The highest closing high occurred on October 9th, 2007. If we look at 117 calendar days, we end up at February 3rd, 2008, which was a Sunday, and that's why this chart is dated February 1st, 2008, which was a Friday. From a trading day perspective, we have our peaks lined up here, meaning we're comparing apples to apples here. We have our peak, then we look forward 117 calendar days. We look forward from the peak 117 calendar days. It's also relevant to compare apples to apples looking backwards. Why? Markets are forward-looking mechanisms. The fact that the market is moving sideways here tells you some market participants were already seeing trouble before the market peaked. And to give us a fair assessment, in both instances, we'll be covering charts that span roughly 1 year. If we look at the peaking process in 2007, price first entered this box here based on this low here and didn't exit the box permanently until here early in 2008. So we have a 10-month period of consolidation. Contrast that with the present day. We're doing it the same way. We're looking at the low and looking backwards. From this low, looking backwards, we entered the box roughly 6 months ago. In this case, we had support, support, and a clear break of support here that occurs within 117 calendar days from the peak. In the present day, we don't really have anything yet that looks like this. Support, support. In the present day, support, support. So as it stands now, this unequivocally, 117 calendar days after the peak, looks better than this period here. Basically telling us 117 calendar days after the peak, the net aggregate opinion was much more bearish here than it is in the present day relative to the consolidation period. Now let's look at trends a little bit and see what we can learn. If we add in the simple 110-day all the way out to the simple 200-day moving averages for illustrative purposes only, we can see here, this is a full bore bullish look here. Blue, the fastest moving averages on top, prices above all the moving averages, and the slopes are all up. 117 calendar days after the peak, this looks quite a bit different. We have several moving average crossovers that are taking place here, and now the slopes of all of the moving averages have flipped from positive to negative, and prices below all of the moving averages. This looks like a long-term trend that's trying to roll over in a bearish manner. How do we look 117 calendar days after the peak in the present day using the exact same moving averages? The answer is quite a bit better. Here, price is below all of the moving averages and the slopes are down. Contrast that with the present day. Price is above all of the moving averages and the slopes are up. In this instance here, price broke below the moving averages, tried to break out, failed, then had another retest, and this retest is a bearish retest. It passed, and price dropped sharply in a bearish manner. Contrast that with the present day. We come down and test, we pass in a bullish manner. Test, pass in a bullish manner. Test, pass in a bullish manner. How long will these moving averages look like this? We have absolutely positively no idea. Taking it day by day. This, 117 days after the peak, looks quite a bit stronger and better than this here. This looks like a trend that's rolled over already, and this looks like a trend that's trying to right itself. Notice, we use the term trying. The outcome is still to be determined. In the present day, this still looks pretty good. It can be very, very difficult to try to discern between a normal correction within the context of an ongoing uptrend and a situation where we flip from a secular uptrend to a secular downtrend. Trends are one of the ways that we can discern between those two outcomes. Asset class behavior can help as well. When the net aggregate opinion is shifting from bullish to bearish, the conviction to own defensive-oriented bonds starts to rise relative to the conviction to own growth-oriented stocks, which is exactly what happened here. Notice, the stock-bond ratio peaks several months before the S&P 500. We're peaking here in the June-July timeframe, the ratio. The stock market doesn't peak until October, telling us that some market participants are already migrating to the bond market before the S&P 500 peaks. Full bore bullish look here, full bore bearish look 117 days after the peak. How does the exact same ratio look 117 days after the peak in 2018? Does it have a rollover look? The answer is absolutely positively no. If anything, we're coming out of a tight clustery look here with a bullish breakout. Typically, when you get a tight cluster like this, that can be followed by a very long-term move or sharp move in one direction. Notice 117 days after the peak, this ratio is making a new low here, right here. We're knocking on the door here of possibly making a new high. The look of this chart is almost the binary opposite of this chart here. How long will that last? We don't know, but that's what we have in front of us today. We'll take it day by day. In this type of analysis, you can usually come up with reasons to discount any one ratio. But it's very, very difficult to discount a broad range of risk-on, risk-off ratios. So let's take a broader look. Logically, it makes sense when the stock market peaked here that some market participants were already migrating to more defensive-oriented consumer staple stocks and migrating away, at least from a conviction perspective, from small caps. We've got a full-bore bullish look here. It flips over to a full-bore bearish look. This chart looks exactly like what we would expect it to look like when we're getting a long-term trend change. How does the same chart look today, 117 days after the peak? The answer is simple. The answer is infinitely better. We have a full-bore bullish look. The ratio here had just made a new low, basically a new one-year low. Here we're making a new one-year high. It's very, very difficult to explain away this chart if we're trying to make the bearish case. How about growth-oriented tech relative to more defensive-oriented gold? If we think the whole financial system is about to collapse, owning physical gold might be a good idea. Notice this ratio peaks before the S&P 500 here. This is a discernible lower high relative to this high, making a new one-year low with a full-bore bearish look. Do we have the same yellow flags waving in the present day? The chart speaks for itself. The answer is no. Instead of making a new one-year low, we're making a new one-year high. How about mid-caps, MDY, in the ETF world relative to intermediate-term treasuries, or IEF? New one-year low, full-bore bearish look 117 days after the stock market peaks. 117 days after the peak in the present day, do we have the same concerning look? The answer is no. Instead of making a new one-year low, we just made a new one-year high. How about a broad basket of stocks, VTI, relative to a diversified and broad basket of bonds? A discernible lower high here, waving yellow flags when the S&P 500 peaks. A new one-year low. In the present day, we're knocking on the door of a new one-year high. And instead of having the slopes of the moving averages all down and price below, the slopes are all up and price is above. How about the Dow 30 stocks relative to Treasury inflation-protected securities, or TIPS? New one-year low. We've got a full-bore bearish look with blue, the fastest moving average on the bottom. The slopes of all of the moving averages are down and price is below. In the present day, price is above all the moving averages and the slopes are much, much healthier. How about if I'm trying to short the market using inverse ETFs? 117 days after the market peaked on October 9, 2007, this ratio had just made a new one-year low and the slopes of the moving averages had all rolled over, price below. 117 days after the peak in 2018, the exact same ratio looks much, much better. Remember, we're comparing the look right here to the look right here. How about internet stocks, Frank David Nancy, in the ETF world relative to long-term treasury bonds? New one-year low, the slopes have all rolled over, price below, 117 days out. Present day, new one-year high, the slopes are all up and blue, the fastest moving average, remains on top. This looks infinitely more sustainable and healthy from a long-term perspective than this. S&P 500 relative to PSQ or shorting the triple Qs or the NASDAQ 100. The ratio here making a new one-year low. And in the present day, much, much healthier with price above all of the moving averages. Blue, the fastest moving average, is still on top. How about equal weight technology, RYT, relative to shorting, or an inverse Russell 2000 ETF or RWM. New low here. The slopes are all rolling over in a concerning manner. We've got lower high, lower high, lower low, lower low, lower low. We've flipped from an uptrend to a discernible downtrend. In the present day, much, much healthier. Just made a new one-year high. Here we had just made a new one-year low, and we're comparing apples to apples here. 117 days out, 117 days out. How about one of the banking ETFs, KBE, relative to shorting the S&P 500? New one-year low. The slopes are all down. Blue, the fastest moving average, is on the bottom. Present day, blue, fastest moving average on top. Slopes much more constructive than they were here. And price so far has held above the moving averages. Look how far back this ratio closed below the moving averages here, and we're still above them in the present day, telling us that the sustainability and strength of this trend is much healthier than it was at any time on this chart here. A fair question might be, the peaking process in the year 2000 and the peaking process and the fundamentals in the year 2007 and the peaking process in 1929 and the fundamentals, they're all quite a bit different than the present day. That is absolutely positively true, and that is always the case. The fundamentals are different here than they are here. The fundamentals are different here than they are here and here. However, the process of rolling over from a bullish trend to a bearish trend looks similar in all three cases. This is what a downtrend looks like, regardless of the reasons why. A downtrend makes a series of lower highs and lower lows. A downtrend makes a series of lower highs and lower lows. A downtrend makes a series of lower highs and lower lows. The same can be said for asset class behavior. In all three instances, we will see examples of conviction moving from the bullish side of the ledger to the bearish side of the ledger, which is exactly what we saw in the peaking process in 2007, and we've just shown using a wide range of examples that we really don't have anything like that yet in 2018. We're not using these charts to forecast anything. We're simply looking at the market's present-day risk-reward profile. And the fact that we aren't seeing similar characteristics to these peaks here tells us we should keep an open mind about better than expected outcomes in 2018, including having the market go on to make a higher high, because that's what markets do 100% of the time after a normal correction within the context of an ongoing uptrend. How can that be the case? If that wasn't the case, we would call them bear markets. And if it starts to morph into something like a bear market, which is absolutely positively a possibility, in that case, the risk-reward proposition starts to get very, very unfavorable, and protecting capital starts to make sense. Since we've been stuck in this long-term range here, and we're delivering a similar message over and over again, sometimes it can be helpful to hear the same message or a similar message from different sources. If you Google this title here, "What Small Cap Strength Means to the Broader Market," you should be able to find a Bloomberg video. This video covers present-day asset class behavior and discusses what can we learn about the market's risk-reward profile based on what we have in front of us today. If you Google this title, "The Stock Market's Broken Leg is Nearly Healed," you can find a MarketWatch article that covers research that basically is saying the same thing we've been saying. Right now, based on what we have in front of us, this looks like a normal correction within the context of an ongoing uptrend. And that's a probabilistic statement based on the facts that we have in hand. That's assessing the probability of going on to make a higher high relative to the probability of going on to make a series of lower lows. It's extremely important to note how we get there is still to be determined. So let's say the bullish scenario is going to play out. Even if that's the case, stocks could go sideways for several more days, weeks, or months, or they could move in this direction, go down and test the bottom of the box, and it's well within the realm of possibility that we could go outside of the box in this direction. Dropping outside of this range by 1 to 3% would not be shocking based on historical precedent. Given what we know today, as of May 25th, we're happy with what we own. That's also important. When we look at all of our options now, the positions that we've been holding in 2018 are still the positions we would buy if we were in 100% cash today. We have no idea how long that will be the case. We'll continue to take it day by day. If the market wants to go to the lower end of the range and even drop below 25.32, we will continue to take it day by day and assess the facts that we have in front of us. Under our approach, it's simply a waste of time and energy to try to forecast what things are going to look like if we get into this area here. Just as we've done in this video, at this point here, if we get here, we can assess the facts that we have in front of us and make logical decisions based on the weight of the evidence. Every single statement that we've made in this video is based on the information that we have in front of us. We're not forecasting in any way. We will continue to take it day by day, and we are open to all outcomes from wildly bullish to wildly bearish. We're very, very confident of assessing the data in front of us. Maximum flexibility comes in. We have no idea what the data is going to look like in 3 days or 3 months. It could be very, very similar, or it could be radically different. If we start forecasting, debating the bull-bear case in a public forum, or boasting about things like the market holding thus far, that's going to bring our ego into the equation, and that is a big, big mistake. Day by day, open to all outcomes, maximum flexibility, no forecasting, and we'll continue to focus on the weight of the evidence. Because the weight of the evidence, if we remain flexible, can help us mitigate some of these losses if we flip over into a secular downtrend. And if the present day probabilities play out, the weight of the evidence could help us capture a very satisfying portion of what can be eye-popping gains when the market comes out of a long-term consolidation period and moves from a harder market to an easier market, from a harder market to an easier market. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.